In this video, we're going to talk about an easy long-term investing strategy for beginners. I'm Tim Wolffe. Welcome to the channel. If you're new, go ahead, hit the subscribe button. And if you get anything out of this video, it helps out a lot if you'd hit the like button. When I'm talking about a long-term investing strategy, we're talking about at least 5 years, something that's going to steadily increase on average 10% return on investment every single year. This is not a get-rich-quick scheme that you see on the internet. This is not some super complex, hard to understand, you need a financial advisor type strategy. This is something that you can start doing today. So whether you have a brokerage account, an IRA, or 401k, however you choose to invest, and whatever platform you use, whether it be Fidelity, Charles Schwab, Vanguard, they're pretty much all the same. It doesn't matter. I'm going to use Fidelity for this example because that's where I have my IRA and brokerage account. So if you go to fidelity.com or whatever company you work with, they're all going to have a list of mutual funds and index funds that you can invest in. And the great thing is it shows all the rate of returns from 1 year, 2 years, 3 years, 5 years, 10 years. So when I go to fidelity.com, I'm going to click on the tab called Investment Products, and then I'm going to go to Mutual Funds. Under Mutual Funds, there's going to be something called Explore Our Fund Offerings. Click that. And on the left here, there's going to be something that says All Mutual Funds. Go ahead and click that. Fidelity, as well as all the other companies nowadays, have a great list of no transaction fee funds that you can invest in. So let's look at that first. And you can see just from this list alone, it gives us over 3,400 different options to choose from. Keep in mind, a mutual fund is a great option because it's a combination of a bunch of different single stocks. So if you only invest in one mutual fund, you're still going to have a good amount of diversity because that mutual fund may have 30 to over 100 different stocks that it's invested in. For example, if you have a tech mutual fund, it may have 5% in Apple, 5% in Microsoft, 2% in Google, so on and so forth. And who's ever in charge of the mutual fund, whether it be a Berkshire Hathaway mutual fund, a Fidelity mutual fund, they have a mutual fund manager that his sole job is to manage that mutual fund and make sure it gets the best returns possible. And this list is all mutual funds that you can tap into all that knowledge and all that diversity without having any transaction fees. So the first thing we want to do is sort this list by 10 years. The column that's grayed out right now, that's highlighted, is going to be all these mutual funds, what they have done year over year on average for the last 10 years. The reason we want to do at least 10 years is because that's going to give us something that's proven, something that's steady and has actual historical data behind it. If you're only looking at 1 year or 3 years, you're not going to get the true picture of how the fund has been performing because it may have had a good year or it may have had a really bad year. You want to look at the least 10 years and that's how we're going to compare. Remember, this is long term, so we want something that's going to continually perform for decades. So now looking at the top of the list, you have several mutual funds that have done over 22%, which is way above our 10%, which is awesome. Now, whatever platform you use, you may want to consider just doing their specific mutual funds. So if it's Fidelity, you may just want to do Fidelity's mutual funds because they're going to have usually the lowest yearly expense ratios. An expense ratio is basically going to be a fee that they're going to charge to cover all the costs of managing that mutual fund. Typically, I like to see definitely under 1%. That's really practical nowadays. On these more aggressive, better performing mutual funds, they're gonna be around 0.5% to 0.75%. So if I come down here and I'm looking at Fidelity Select Software and IT Services portfolio, this is gonna be a technology mutual fund. And if I'm like, hey, this thing performs really well, over 20% every year on average for the last 10 years, and I think technology is the future, this may be one of the mutual funds I want to pick. And when you click on it, it's going to give you more details about the actual mutual fund. It'll compare it to the S&P 500. If you scroll down, you're going to see, so this is invested in things like Microsoft, Visa, Adobe, MasterCard, big companies, Google, that we've all heard about. And you can see a full list that has 71 different things that it's invested in. So I've looked at the charts, I've looked at the data, I looked at what it's invested in. I'm like, hey, this seems like it's something that's good. I think technology is going to keep going up. These companies are going to keep growing in value. Therefore, the mutual fund is going to keep growing in value. I think this should be one of the mutual funds in my portfolio. Boom, and you can pick that mutual fund. And if one of those companies do start to fold, the mutual fund manager is going to see that. That's his job to predict that. And they may exit out of that position and supplement it with another company within the mutual fund. If you're just starting out with $5,000 or only a couple $100 or up to $10,000, I would suggest just sticking with 2, maybe 3 different mutual funds. And again, every different trading company has a list like this. You just need to find all their mutual funds and sort it by 10-year. If you believe in healthcare and the cost of pharmaceuticals is going to keep going up, then maybe you want to do their healthcare mutual fund. Another one that's very common is something that's called large growth or large cap mutual funds. The Fidelity OTC Portfolio one is a popular large growth one. It has done 18.78% on average for the last 10 years. That's good. That's above the S&P 500. Once I do a little bit of research on it to see what I'm actually investing in, Apple, Microsoft, Google, Amazon, Facebook, Marriott, Twitter, companies like that, hey, I think those companies are good. Because it's a large cap or large growth, I mean, it's going to focus its investments on giant billion-dollar companies. Companies like Amazon that drive the economy of the United States. So if you like doing the technology one, you like doing a large growth, large company one, cool, there's your 2 right there. You can invest in those and probably never touch them, and you would have an awesome annual rate of return every year until you retire. If you want to pick 1 more, you want to pick 2 more, that's great. Just go back to the list, make sure it's outperforming the S&P 500, which historically has done about 10.7% every year. So we want something that's better than that, and you can invest in that with no transaction fees. So if you want to trade into it every single month, you can buy another $100 worth of shares, $1,000 worth of shares, whatever you want to do. You can keep investing in it every week, every month. It doesn't matter. There's no transaction fees every time you buy or you sell. So I hope that's a quick and easy investing strategy for you guys to have. It's still aggressive enough where you're gonna have good returns, but it's not risky enough where it's gonna go shoot up, shoot down, shoot up, and you're day trading every single day. These are funds and stocks that are based on the entire United States economy. They're based on long-term historical data that's gonna be proven to be there when you go to retire 5 years from now, 10 years from now, 40 years from now. If you have any questions about this, you can always comment down below. And please go ahead, hit the subscribe button if you haven't done so already. And I'll be sure to see you next week for a new video.